Hi friends, Dr. Joe here. I hope you all are doing great and welcome to this video. In this video, we are going to discuss about a very important thing in trading. It is called as the market structure. As a trader or an investor, if you understand the market structure, you will be able to take successful trades which are profitable in the markets. To understand market structure, we need to understand two basic things. One is a simple market structure, and the second one is a complex market structure. So, in this video, we're going to cover both the simple market structure and the complex market structure. And the most important thing, how do you enter trades in a simple market structure and how do you enter trades in a complex market structure? Friends, if you're still not subscribed to my channel, kindly subscribe to my channel and smash that bell icon. Every time I see a new subscriber, it motivates me. Now let's get back to the topic of this video. To understand the market and to successfully trade in the markets or invest in the markets, you need to understand what are the major trends in the market. So there are three major trends in the market. One is an uptrend, the second one is a downtrend, and the third one is a sideways market. You can also call it consolidation or a choppy market. Now, when you talk about a bullish market or an uptrend market, you will clearly see that there are higher highs and you will see there are higher lows. When you see a continuous set of higher highs and a continuous set of higher lows, this is a clear indication that the market is in an uptrend. When you look at the real market, you will see something similar. The cream color spots are the higher high and the light blue color spots are the higher lows. You can clearly see in the price movement that there are higher highs and higher lows, which indicate that the market is in an uptrend. Now, every time the market is moving up and the price breaks a previous higher high, or you can call it a resistance zone, before the break of structure, every chart you will see a major high and a major low in an uptrend. So these 3 points are very important points. The major higher high, the major higher low, and the break of support zone. If you understand these three things, you will be able to understand how the markets are moving. When you look at a downtrend or a bearish market, you will see similarly lower lows and lower highs. A series of lower low and a series of lower high means the market is bearish, or you can say the market is in a downtrend. When you look at the price movement, the cream color spots are the lower highs. You can clearly see the price is coming downwards. And the light blue spots are the lower lows. When you see it is like a step coming down, this clearly indicates that the market is bearish, or you call it a downtrend market. Break of structure is when the price breaks the previous lower low and continues in a downward direction. It is called as a break of structure. And similarly, there are three important points you must understand. That is the major lower low, the major lower high, and the break of support zone. Once you understand these three things, it will become easy for you to enter a trade in the bearish direction. The third important thing is the sideways market or the ranging market. In this market, you will see equal highs and equal lows, or a little bit above the equal high or a little bit lower the equal high. Same, a little bit below the equal low or a little bit above the equal low. When you look at this price movement, you can clearly see that the price is touching the resistance zone and falling down, and then it touches the support zone and then rises up. This continuous movement creates a series of highs and lows, but they are almost in the same range. That is the reason this type of market is called a ranging market or a sideways market. So these are the three types of markets that you have seen: an uptrend, a sideways market, and a downtrend. But these uptrends and downtrends are basically a simple market structure. Simple market structure looks simple, like a higher high, higher low, and a lower high and lower low. It looks very, very simple. But the real market never looks like this. In the real market, you will find complex market structure. Now let us understand what is a complex market structure. Like you can see, an uptrend or a bullish price movement over here, where you can see higher highs and you can see higher lows. Now let us look at this light pink area in this uptrend. When you break it down, you will see that the price within that light pink area also moves up and down, up and down, up and down. So there are major highs and major lows, and within that major high and major low, you will see minor highs and minor lows. This is what confuses most of the traders. Similarly, when you see this light blue zone over here, within the light blue zone, you will see that the price is going up and down, up and down. Again, traders get confused over here that a downtrend has started. But to confirm that the price is in a downtrend, the price actually has to break a major low. So a major high and a major low plays a very, very important role. Now let us understand what is a major high and what is a major low. Like you can see, the first part of this chart is a simple market structure where the price goes up, reaches a resistance, comes down, reaches a support, goes up, creates a new resistance. On the way, there is also a break of structure because the price breaks the previous resistance and move in an upward direction. So this is basically a simple market structure. But if you look at the second part over here, you will see between the high and the low, there is multiple highs and lows. These are called as minor highs and minor lows, or you can call it as an internal structure. So the major ones are the major highs, which are green in color, and the major lows, which are red in color. These are called the external structure. What is more important as a trader or an investor is to understand the external structure. If you understand the external structure, you will never take a trade against the trend. So it is very, very important to understand the external structure. Once the third point is created over here, which is the next major low, now your view has to shift from this major low to this major low. Now you have to look at the price movement between these 2 points, this major high and this major low. Now if the price breaks this major low over here, then you will consider the price to be in a downward direction or in a bearish direction. Until the price breaks this major low, the price is in a bullish direction. Now it might go bullish, it might go sideways, but still the price is in the bullish direction. So this is the major thing as a trader you must understand: the major highs, major lows, and the break of structure. Whenever the price breaks a major high, it is called as a break of structure in the bullish direction. And whenever the price breaks a major low, you call it a break of structure in the bearish direction. Whenever the price breaks the major high, it is called as a break of structure. So we have got one break of structure, we have got two break of structure over here. Why? Because the price is moving in an upward direction and it breaks the resistance level and continue upward. This is called the trend continuation pattern. Now, when do you call that the trend is reversing? Here you can clearly see there is one break of structure, two break of structure. After that, the price comes down. It has created a third higher high. So we have a higher high 1, higher high 2, higher high 3. But then the price does not go back up. It continues in the downward direction. Here you can see the first major low, the second major low. The price breaks the second major low and continues in a downward direction. This is when you're going to say that the trend has reversed. When price breaks the BOS support and continues in a downward direction, it is called as a trend reversal. So these are very, very important points. And as I told earlier, major highs and major lows, which are the external structure of the price movement, is something that you should focus on while you are trading or investing. Now let us understand how can you confirm that whenever a break of structure happens, it is a valid break of structure. Now here you can see point number one, break of structure. Point number two, we are waiting for the break of structure to happen. Now have a look at this candle. This candle starts below the resistance zone and breaks the resistance zone and closes above the resistance zone. This is a bullish candle, a very, very strong bullish candle. When such kind of movement happen in the price, it is confirmed that the break of structure has happened and the price will move in an upward direction. So this is a confirmation that this is a valid break of structure and a bullish trend continues. Now, when do we say that it is an invalid break of structure? Same thing, BOS1, BOS2. We are waiting for the break of structure to happen in the third point. But you see the price moves up. The price breaks the resistance zone or BOS2. But before the candle can end, the price retraces back into that zone. So the candle ends below the resistance zone. When the price breaks the BOS resistance, but the candle fails to close above the BOS level, then it is called as an invalid break of structure. So this is something you must notice. Every single candle plays a very, very important role at this particular zone, whether it is the major high or the major low. External structure is a very, very important zone, and the candlestick patterns in this zone plays a very, very important role. Now remember, till the price does not break this major low, the price is still in an upward direction. Just because this was an invalid BOS or an invalid break of structure, it does not mean that the trend has reversed. The trend reversal confirmation will only happen after this major low 1, major low 2. Once the price breaks this structure of major low 2, then only we can confirm that there is a trend reversal. Now, how do you confirm that a bearish trend is continuing? So you see major low 1, major low 2. The price did not continue in the upward direction and it started coming down. But when the candle breaks the support zone with a strong bearish movement and closes below the support zone or closes below the major low, which is the external structure of the chart, then you can confirm that the major break of structure has happened, which is break of this support zone, and the price can continue down from here. This is a confirmation of a trend reversal. And how do you understand whether it's an invalid break of structure? Similar to what we saw in the bullish direction, similarly in the bearish direction. Major low 1, major low 2, the price moves down but fails to close below major low 2 and the price retraces back into the zone. When such a price movement happens, it clearly shows that it is an invalid break of structure and the price is still in an upward direction. Please do not change your view at this point that the price has started moving in a bearish direction. At this stage also, the price is in a bullish direction till a major low 2 is breached with a strong candle going in the downward direction. Now let us have a look how a real chart looks like. So here you can see at this point over here is a major low. This point here is a major high. This point here is major low 1. And this point over here is a major high 1. So 1, 2, 3, 4 points are the major points. But within that, can you see there is so many minor points? This is how a real chart is going to look like. So whenever you are trading, there are two types of trading that you can do. The first type of trading is called simple market chart trading. So whenever you are trading a simple market structure, you are only looking for major structure. Okay. So major highs and major lows. So when a price does a break of structure and goes in an upward direction, breaks a higher high, then you wait for the price to retrace back and create a major low at the previous major high, and you enter the trade. As you can see, the risk and the reward. The reward over here is 1 is to 3. But this is how you're going to trade a simple market structure. But what do you do if the market structure is complex? Now, when the market structure is complex, you are not going to find the price make a clear support and resistance zone. So, what you have to look is for the minor support and resistance zone. So, within this major low, major high, major low, major high, which has already told you that the price is in a bullish direction, then you look for minor highs and minor lows in an upward direction because the major trend is in an upward direction. So this complex market structure will not give you a clear trade of major highs and major lows, but it will give you a clear trading indication with minor highs and minor lows, and you can go ahead and take those trades. So understanding the market structure is very, very important. And your trading pattern is very, very important. When you're trading, you have to understand that you want to trade at major points or whether you're okay to trade at minor points in the direction of the trade. So if you understand this, the major points and the minor points, a long-term trader or an investor will look for major points, the major highs and the major lows. Whereas an intraday trader or a scalper or a swing trader is going to look for minor trading points within the major trend. So as a trader, you have to first decide what kind of trader you want to be. If you're going for long-term trading and simple market structure, then focus only on the major. And if you're looking for intraday scalping, swing trading, then you can look for minor points, but in the direction of the trend so that you get the trend behind you, which will help you to get better profits, a better risk to reward ratio, and a better win ratio. Now, remember, friends, any kind of trading cannot be successful without managing your risk. So, if you are a new trader, I would suggest you go with a 1 is to 2 risk to reward ratio and risk 0.5% of your equity in each trade. And as you mature in trading, you continue with 1 is to 2 risk to ratio and you increase your risk management maximum up to 2% of your equity. And once you become a master in understanding the market structure, then you can increase your risk to reward from 1 is to 2 to 1 is to 3, 1 is to 4, 1 is to 5, maybe 1 is to 6 also, till the market does not change its structure. So that is the reason it's very, very important to understand the major structure and the minor structure, or a simple market structure or a complex market structure. So I hope, friends, this video has made it extremely clear that what is a major market structure and what is a minor market structure, or what is a simple bullish trend and what is a complex bullish trend. Both these points are equally important if you want to understand trading. So focus and understand what these points mean. Once you understand these things, you will be successful in trading. Remember, friends, these things you're not going to learn just by looking at the chart once or twice. You have to focus on the chart. And this requires a lot of practice, patience, and persistence. So all these three things are important if you really want to become a successful trader in the stock markets. Friends, if you love the way I've created this video, kindly like and share this video. So like you, there might be many others who want to learn trading and understand these small, small concepts about the charts and trading. This will surely help them to become a better trader from what they are today. Well, that's all in this video, my friends, but I do not want to quit this video before I say this. Keep learning, keep growing, keep getting better every single day. Thank you. Namaskar.